Isabelle Bourcier is Head of Business Development at Ossiam, an affiliate of Natixis Global Asset Management. She specializes in smart beta strategies. Isabelle, welcome to the studio.
Good afternoon, Nicolette. Thanks for having me today.
Isabelle, what are smart beta strategies, and what is the one that you're very strong on, which is minimum variance?
Smart beta strategies are a new form of systematic investment, new indices which aim at minimizing and correcting the limitation of traditional indices, which are usually over-concentration and trend-following bias. One of the strategies on which we have been focused since the development of the company is minimum variance, where we've collected significant amount of assets under management. We've developed several type of indices, type of ETF actually, to track those indices on minimum variance for US, Europe, emerging market and global equities. The aim of the strategy is to minimize the volatility of an investment into US equities, European equities, emerging market equities, and on the long term create overperformance thanks to asymmetric markets, or market going sideways, as this strategy would work very well in this type of market environment.
We have an example here where we see the volatility over a period of over 10 years of the index, in this instance the stocks Europe 600, and the volatility of your product, which is clearly much lower.
This is a one-year volatility from 2003 to 2013. As you said, comparing the Stocks Europe 600 index and the iStocks Europe minimum variance, which is an index that we've developed jointly with stocks around a minimum variance approach that has been created by the research team of Ossiam. And clearly it provides a good diversification and also minimize by at least 30% on average the volatility of European equity long-only portfolio.
But the performance of these products tend to attenuate the rises and the slumps of the normal markets or the normal indices. Can you explain exactly how that works?
Yeah. So in a minimum variance strategy, because to minimize the volatility, you're going to be selecting stocks with a low volatility level. So the process, which include different steps, including some filters in terms of liquidity to remain exposed mainly to large and mid-cap stocks, and a process for selecting and weighting stocks based on the historical volatility of individual stocks and their correlation. So to minimize the risk, we're going to be willing to select the stocks with the least volatility and the least correlated within the portfolio. As a result, in terms of, as you can see here, simulated quarterly returns, we're going to have a profile of the strategy where in downside market, the participation of the strategy is going to be around 50%. Which means that each time there's large drawdown in the market, we're going to minimize those drawdowns, so the portfolio investment is protected on the downside. And on upside market, we're going to lag, but to a level which is significantly higher than the protection, the participation on the downside. We usually capture 75% of the upside and only 50% on the downside, which create over time overperformance for the minimum variance. So it's a strategy which is more a buy and hold type of strategy for investors that want to be exposed to equities because they need returns, but at the same time don't want to take too much risk by minimizing the volatility and minimizing the drawdowns through those type of investment.
And you're now going to have to apply smart beta to commodities. So what is this going to be and how is it going to work?
Yeah, so the philosophy is the same. I mean, the philosophy of smart beta is to build new indices and new ways of constructing portfolio in a very systematic way, but with a specific objective. I mean, the traditional bias of indices, market cap indices for equity, production weighted indices for commodities, tend to focus and tend to have a strong concentration on large cap for equities, and in the case of commodities, a large concentration on oil, for example. The oil sector in the S&P GSCI index represents 65% of the index in terms of weight, and more than 80% in terms of risk contribution. So the idea was the same as with minimum variance. The idea was to provide investors for their global asset allocation and the possibility to invest into commodities, a global commodity portfolio, but with less risk, with minimizing volatility. Volatility on the commodity side has been increasing a lot over the last 10 years, if you look at period from 2003 to now. And this is obviously why you need to minimize volatility, is really to be able to get average returns and returns that are not going to be impacted by up and downs of the market. I mean, typically, if the market goes down by 50%, to go back to your initial investment, you're going to have a 100% upside to go back to your initial investment. This is very intuitive, but this is the main reason why you want to minimize volatility. And on the commodity side, the idea was to build an index more diversified, with less weight of the oil sector, based once again on data, which is historical data, historical volatility of each commodity and futures contract, in order to design an allocation that will be more diversified and less risky for the investor.
And though you are excluding wheat, corn, and soya from your index.
Exactly. For ethical reasons, those food-related commodities have been excluded from the portfolio.
Isabelle, thank you very much for joining us today.
Thank you, Nicolette.